Thank you, Mr. Chairman, and thank you, Mr. Chairman, for being here today. I want to start just with following up on the exchange you had with Mr. Sherman. As I think you know, I led a letter with 106 of my colleagues with concerns about specifically the clean energy tax equity provisions in Basel. I appreciate your commitment to look at that. I wonder if I could just put a little bit of a sharper point on it. Can you look at that before the rule is finalized and potentially issue some sort of an addendum to the rule? The concern I have is the number of banks who are a little bit frozen right now, waiting for some clarity on that, and I'd prefer we not slow down the rate of clean energy investing in our country if we don't have to.
I don't know. I mean, I think there's a proposal, and you know, we're well aware of the commentary, and we're going to react appropriately. I don't know that we can pull one thing out of line and deal with it. But we're making good progress, and I think we'll be back reasonably soon with some answers. Okay, well, time is of the essence. Appreciate anything you can do.
Second thing, good thing about going late here, you get to follow up. I want to follow up on your discussion with Congresswoman Garcia here. I really appreciated your comments in the 60 Minutes interview last month when you mentioned that immigration is a big part of the story of the labor market coming back into balance. Now, generally, and correct me if I'm wrong, more immigration is generally going to ease inflationary pressure. Is that all else equal? Is that a safe characterization?
You know, it's probably closer to neutral, actually, because you know, people come in, they also spend. You know, so it's not clear that immigrants coming in, they add to GDP.
Okay, so either we're going to get economic growth and/or downward pressure on wages.
More workers, so that wages might go up a little bit less, but at the same time they're also spending. So we had this conversation. It depends on what you assume, but I think it's better to just assume it's sort of broadly neutral from an inflation standpoint.
So I guess, and maybe you've answered the second question, but given as you all are using the Census Bureau data that is more conservative than the CBO data, and obviously we're all making estimates in the future, can you speak at all to whether your forward views on economic growth and inflation, how sensitive are they to your assumptions about that census versus CBO data on what the actual level of immigration is to the country right now?
I think the CBO assumptions are meaningfully higher and would affect growth and would be part of the explanation why growth was strong last year and would be a reason to expect. I mean, it's not the main reason, but it would definitely add to growth this year. And I wouldn't say that we accept one version of the other. We're studying. We study the CBO numbers carefully. We're just trying to get to the right answer. And but I mean, I think the CBO shows, and they say so, stronger growth, higher growth, more people. I don't know the per capita growth goes up, but the absolute level of growth goes up.
Okay. Last question. I think there's a lot of good news in the monetary report that you all just issued around wage growth. We've seen, the lower quartile of earners starting to close some of those historic gaps. We've seen minority groups and women start to close some of those gaps. What I didn't see, and I don't know if this is because you all haven't done it or I just didn't read closely enough, have you seen any gaps regionally within the U.S.? Are there parts of the country that are seeing stronger wage growth than others?
There are. I don't have that off the top of my head. I want to go back and, if I can just, when I talked about immigration, I think that the immigration story for last year was part of the positive supply shock and was part of the reason why inflation came down. I was really asking the question over the longer run.
Fair enough.
And there, I think it's more of being neutral.
I appreciate that. I want to just close on this regional piece because the Atlanta Fed, which is the best I could find that looks to do at least some by census regions, that as I look through, there's and you look at which regions are consistently running above. I think that New England and the West are consistently showing wage increase above average, and the West, South, Central, Texas, Oklahoma, Arkansas, Louisiana are consistently, I think going back to like July of 2022, consistently seeing wage growth below average. And I appreciate you're not going to wade into a political question here, but those are all right-to-work states where it's harder to unionize, where it's harder to organize. And what I'm wondering is, without asking you to opine on policy, have you all at the Fed done any analysis that says, as we look at when there are gains in labor productivity, does that gain in labor productivity, is it more likely to accrue to workers in those states where there's a stronger union presence, easier to organize, and more bargaining power for labor as opposed to capital?
My guess is there's plenty of research around that area, not necessarily at the Fed, but we'll take a look and come back to you.
Okay. All right. Thank you. I yield back.